Hello, and welcome to this short video about my final year project, Evolving Deep Fuzzy Ensemble Neural Network for Portfolio Management. In this project, I'll be using AI, fuzzy logic, and deep reinforcement learning to develop a robust and profitable portfolio management system. When investing in a stock portfolio, people often ask these questions. Which stocks should I buy? How should I allocate and adjust my investments so that I can earn a high profit? How much return can I expect at the end of, say, 5 years? Experts in both the finance and technology industries have tried to address these questions using technical indicators, deep learning, and domain expertise. However, they all have their own limitations. The technical indicators can tell us when the price trend will reverse, which is very useful for trading cyclic stocks, but there is an inherent lag in the generation of these signals because they're usually calculated based on past information. Deep learning models can predict future prices with very high accuracy, but they're essentially a black box and does not provide any logical justification for the predictions. This may not be sufficient for their adoption in the financial industry, where risk management and regulatory compliances are important. Traditionally, people also hire professional portfolio managers to monitor and adjust their mid to long-term investment. But they have to split their time and attention between several portfolios they're managing and may not be able to consistently respond to new patterns and information in a timely and objective manner. In view of these challenges, the objective of my project is to design and develop a system for stock portfolio management that uses Ensemble fuzzy transformers to accurately predict prices, and these predictions can be explained using if-then logic. Modified technical indicators are calculated both on past and future information to minimize the lags, and deep reinforcement learning is used to allocate and dynamically rebalance the weights of each stock in the portfolio and compensate for residual delays in the trend reversal predictions. The end goal is to develop a system that is robust in various market conditions, and it can optimize returns and has the potential to evolve with new patterns. The methodology of this project can be split into 4 main steps. First, a portfolio is constructed based on a selection of stocks using fundamental analysis and making sure that these stocks are not very highly correlated in their price movements. Next, the stock data are fed into the fuzzy ensemble transformer models to predict for the future prices. This model has 5 layers. The first layer is a crisp input layer that contains the crisp input values. They're loaded as time series vectors. The second layer, the fuzzy input layer, is responsible for data preprocessing, normalization, clustering, and fuzzification. The top of the third layer is a transformer architecture that predicts a specific look-ahead price for a stock. And the bottom of the third layer is a fuzzy rule layer, which contains the if-then rules, each with a weight reflecting its contribution to the predictions. In the fourth layer, the fuzzy output layer, the model defuzzifies the output to gain the crisp predicted feature value. The last layer contains predictions of the target feature, which is used to calculate the price predictions. Using an ensemble of 13 transformer models, each responsible for predicting a specific look-ahead price, we can obtain these forecasts with the accuracy of 98% for individual look-ahead and a compound accuracy of over 80% for the entire forecast horizon of 13 days. Instead of using only historical data, the modified indicators are calculated using both historical and predicted future prices from the model in order to reduce the lags. The modified indicators are closely related to the perfect indicators with ideal hindsight and are better than the vanilla ones. Lastly, we supply the modified MACD and RSI to a deep reinforcement learning system to determine the best allocation and weight adjustment strategy for a 5-year investment of the portfolio. We then evaluate the performance in terms of total return, average annualized return, and Sharpe ratio, and this is benchmarked against popular strategies like min-variance allocation and buy and hold. In the first experiment, it was discovered that a combination of both modified MACD and modified RSI generates the highest return. Therefore, the two of them will be used ensemble in the following experiments. Out of the 5 deep reinforcement learning algos I tried, DDPG and TD3 delivers the best results. Their average annual return and Sharpe ratio are higher than the buy and hold strategy, but the total return is slightly lower. Upon closer inspection, the high returns of the portfolio can be attributed to the increase in price for all 4 stocks during the investment period. XOM, UNH, and MRK are generally displaying a stable increase, while NVIDIA alone has experienced a huge surge in price. Despite the special market condition, DDPG and TD3 managed to achieve a comparable return, which is not far behind the buy and hold strategies. We next tried out in a more volatile market condition of a different period. In this volatile period, DDPG and TD3 still outperforms buy and hold strategy by 14.3% in average annual return, and the total return is very close to the baseline. Comparing the two market conditions side by side, it can be observed that the returns of both DRL and buy and hold are primarily limited by the market condition. For both the bull and volatile markets, the total return of DRL-based strategies are slightly lower than the baseline, though the gap has decreased from 25.2% in the bull market to 9.7% in the volatile market, indicating the system's ability to handle price volatility and maintain a satisfactory and stable return. Even in the volatile market, the best DRL strategy can yield an annual return of over 5%, which is sufficient to beat most inflation rate for the more conserved investors. We can conclude that the proposed portfolio management system is robust in varying market conditions and is able to generate a satisfying return, although there is a potential for improvement in optimizing these returns. That concludes the short introduction video. Thank you.